everyone. Good evening, good afternoon, good morning, depending on where you're connecting from. I'm excited to have you on this show today. Money Matters. And what do we do in Money Matters? It's a movement where we talk about how to make money, how to multiply money, and how to manage money. We want to retain and keep whatever resource the Lord has committed into our hands. And in doing so, we learn how to save, we start saving, and not just savings or leaving the money in the bank because savings will do you nothing. You're either saving for an investment, saving for your budgeting, or putting money aside for a certain thing. But money should not be left in the bank. You're saving that money for an investment that you want to do some other time because you do not want inflation to eat up your money. And also, beyond just savings, we talk about life insurance, health insurance. We talk about means and how to protect your money. We talk about businesses you can do in the 21st century. We also talk about how do you get your product or your services to those who are in need of it. So beyond that, all the focus is to ensure that we make, manage, and multiply money. And here we'll learn about financial discipline, financial planning, and so much more. Everything has to do with, creating wealth, generational wealth. It is said that a good man leaves an inheritance for his children. And so that's the generation that we are, and that's what we're building. And so I have a guest with me, Bobby Jackson, who will be taking us on the topic, how to protect your money. But before I bring you on board, I'd like to introduce myself. My name is Sandra Oko. I'm a Maxwell Leadership Certified Team Member, Coach, Speaker, and Trainer. I'm also a member of the Toastmasters as Vice President, Public Relations. I'm also a best-selling author and an IT sales expert of over 20 years. And just recently, I got the Presidential Lifetime Award. I'm excited to be in this show today, and I welcome everyone. I'd like to know where you're connecting from. And should you have any question, you can drop them in the comment section. And if this is your first time to be on this show, please kindly like, subscribe, and hit the notification bell so that often you can get update from us when we are live. Thank you. The next person you get to see is Bobby himself, who will be taking us on a deeper dive on how to protect your money. Thank you. You're welcome, sir. So great to have you.
Well, good morning, Sandra. Thank you for having me today.
Are we morning or evening? Okay, well, the ministry greets morning all the time. Good morning,
it's always morning. That's right. It is always morning. Well, thank you. Thank you again for giving me the opportunity to share some information here today. Yeah. And just like I love what you started off with as far as money matters, talking about how do we learn how to protect our income, how to properly steward what God has given us. Prior to me getting into this, let me just give a brief background. I used to work for the Army. I worked in a company called DFAS, which was Defense Finance and Accounting Services. So I did that from about 2004 to about 2014. And then from 2014, I switched into the financial services industry. And some of the reasons why I got into that is because, one, I learned at 2014 that I was not, Sandra, going to be able to retire comfortably until I was in my 70s because I didn't understand how that worked. And you actually started, you mentioned a little bit about it, right? I was saving in the bank, but I was also saving inside of my TSP, which is like a 401k for the military, but it wasn't going into the right places and it was getting a low rate of return. So it was taking a long time for that money to grow. So I was definitely one of the people that you were talking about, right? So I figured out how that worked very quickly. And then I got into the industry because I also at that time started to learn and how, protecting my income worked. And I started to understand that what I had from my family did not really benefit the family the way my family the way I thought it would. It actually benefited the company more. So what we're going to talk about a little bit today is how to protect our income, right? And I think this is one of the founding conversations that every family needs to have, right? It's one of the biggest challenges, Sandra, pretty much across the country, right? When it comes to protecting our income. Think about it. When we're building our financial house, or if we're building any house, wouldn't you agree that the most important part of any house is the foundation, right? Before we build anything on a house, we have to start on a firm foundation first.
Sure.
Right? So when it comes to a financial house, what is that? That's protecting our ability to earn income, right? Because we may have other goals. We may have goals of getting out of debt, saving for retirement, putting our children through college without student loans, right? Paying off the house, traveling, whatever the goal is, those are all financial goals. But without protecting that foundation first, then if something happens and that foundation crashes, everything else
Almost.
crumbles as well, right? So we want to start our planning, our strategic planning, by learning how to protect our income, right? And let me give you an example. I often use this example sometimes, Sandra, and I'm going to use it, right? So let's say, for example, how do we protect our income? Well, let's look at it like this. Let's say we all have a toaster inside of our house, right? But it's not any ordinary toaster, Sandra. It's a magic toaster. All right. And what's going to make this a magic toaster? Well, let's say every 2 weeks, let's say on the 1st of the month and the 15th of the month, this toaster, Sandra, is going to give you $2,000. Right? Wouldn't you be excited if this toaster gives you $2,000 every 2 weeks?
I'll be glad.
Right? You probably wish we had two of them, right?
Yeah, so that you have more money.
Right? You're going to have more money. Now, if you had a toaster like that inside of your house, wouldn't you make sure you had insurance on this toaster, so that way, God forbid, if the toaster breaks, you can call the company, so that way they can replace that and make sure you have another one that's going to keep doing and keep giving you $2,000?
Sure.
Right? All of us are going to do that, right? But now, obviously, we also know that that toaster doesn't exist in real life, but it actually does exist in the form of us, right? I'm the toaster for my family. If I work a job, I bring in a check. I'm bringing in money every 2 weeks, right? If I own a business, I'm getting paid every day or every week or every month, right? I'm the toaster. So the question is if it makes sense to insure an imaginary toaster, doesn't it make sense to protect and insure our own income?
It does.
It does, right? It makes sense to protect our own income. So let me give you an example of why this becomes so important, right? So let's say we have a family. You have a husband and a wife, and let's say they both work, Sandra, right? Let's say the wife makes $3,500 a month at her job. The husband makes $3,500 a month at their job. And like most families, they use each other's income to provide for the family's lifestyle, right? So let's say together they're bringing in $7,000 a month. But the question is what do they use that $7,000 for? They're using it to pay for the mortgage. They're using it to pay for childcare. They're using it to pay for insurance, auto insurance, health insurance, right? Their regular lifestyle.
True.
But now, God forbid, Sandra, what happens if one of the couple, right, the husband and the wife, what happens if one of them passes away and one of them dies?
It becomes difficult to meet all the obligations.
It becomes difficult because now they went from living on a $7,000 lifestyle to half of their income.
4,000 or a 3,500.
Exactly. So 3,500. So what does that mean? That means one of them are stuck trying to provide for a $7,000 lifestyle with half of the family's income. Can you imagine at our jobs right now, if our jobs decided to pay us half of our salary, how would that affect our ability to live the same life? Right? It would affect it greatly. Right? So one of the biggest things and the biggest belief that I say is hurting our communities is when it comes to protecting our income, most people think it's just to take care of a funeral if we pass away. Right? Which is why you ever seen, Sandra, so many people when somebody passes away, we have something called a GoFundMe, right? People do the GoFundMe campaign, or they have family members that they try to raise money. And what are they raising money for? They're really just raising money to take care of the final expenses. Right? But now my question is let's say they do raise up enough money to take care of the funeral and the final expenses. What happens the following month when the mortgage company calls and they need their money to pay for the mortgage? Have we ever seen people come back together and do another GoFundMe to help that family pay for the mortgage? Right? Never seen it. Right? Or for the child care. So we can just imagine, without protecting our family, that is one of the biggest detriments, right? Protecting our income. Because God forbid, if our income stops, it changes our family's lifestyle. Right? So that's the first thing, starting with that understanding of what are you doing when you're protecting your income? You're securing your family's lifestyle, even if you're not here. So now what does that look like in the industry? Well, in the industry, that's called life insurance. Yeah. Right? It's actually called life insurance, which is probably the number one way to protect your income. God forbid if my income stops and I pass away.
True.
Right? So now in the industry, there are two main types of life insurance. All right. So the biggest thing that you're going to hear in the industry It's called permanent life insurance or cash value life insurance. Now, that is a lot of different types, right? Or it has a lot of different names. We have whole life insurance, that's cash value. You have universal insurance, that's index universal, universal life, variable life, right? You have a lot of different cash value types of policies. All right. And then you have something called term policy. You have several different ones of those too. You have term, you have decreasing, and then you have, excuse me, you have level term, you have increasing, decreasing. All right. So let's just talk about a couple of them today, right? The first one that we'll talk about is, let's talk about cash value, right? A lot of them are very, very similar. How does it work? All right. And what does it mean for you? First thing is we got to understand, how is it marketed to us, right? When it's marketed to us, it's marketed as, hey, you need this life insurance for the rest of your life. It's permanent. So you need it till at least you're 100 years old. All right. You can also use this money as a savings. You can use this money as an investment. You can use it for retirement. You can use it for your children's education. That's typically how it's marketed to us. And it sounds very well, right? I have insurance and I have a savings all bundled together. So the first thing you want to know is, how do these policies work? Well, the first thing is you have insurance and you have a savings component to it, right? And it's bundled together. All right. So I got insurance and I got savings, and it's bundled together. So the first question is, it happens to be one of the more expensive type of life insurances out there. Why is it so expensive? It's because it's not just insurance. It's insurance and savings. That's why it's so expensive. All right. But now when you first get this type of policy, what you're going to see is they're going to tell you, all right, you're going to have a cash value. You're going to build savings, but it takes time. Actually, sometimes it takes 2 to 5 years for you to even see any money inside of the cash value. So imagine, Sandra, how do you think I would feel? Let's say if I'm putting in $500 a month. I'll use my example as well, right? If I'm putting in $500 a month, and I do that for the first 3 years, and then I call the company and I say, hey, I want to use some of the money in my savings, in the savings component of or my cash value. What do I have? Can you imagine how I would feel if I would have put in like $15,000 and I asked them what's inside of it, and they told me there's only $4,000 inside of it? Right?
You feel so bad.
I feel a little upset. Like, where's my money? Right? Well, here's a couple of things. Why does that happen? For a couple of reasons. One, that money is actually being used to pay for the company's fees first. It's being used to pay the commissions for the agents, right? It's benefiting the company first, right? So it benefits them before it really benefits me in the beginning, right? So then, Sandra, what happens is, I didn't really understand that in the beginning. So what's going to happen? I'm not going to know that that's happening, right? I'm just going to keep putting my money in.
True.
Then later, what's going to happen? Let's say if I want to use my money later down the line, there's 2 ways I can use my money. The first way that I can use my money is they give it to me in the form of a loan, right? Which means I got to borrow and pay it back with interest, right? So now, Sandra, let me ask you a question. Like, if I'm putting
your money, you pay an interest to get on it?
Absolutely. So one of the ways to take money out of it, if you want to use it, you got to, one of the ways is you got to take it as a loan. And the interest rate can be anywhere from 4 to 8% interest. That sometimes accrues daily, depending on the type of policy.
Oh.
Right? But that's one way. The other way that I can use my money, some policies will allow me to withdraw the money. What does that mean? That means, let's say I have $50,000 in my cash value and I decide to use $10,000. Well, what they'll do is, when I take the $10,000, they'll deduct that from my life insurance. So if I have $100,000 of life insurance, now I only have $90,000. Right? So that's one of the biggest things, how you have access to your money. Now, one of the third things, Sandra, is what happens, God forbid, my money has been paying for 2 things. It's been paying for my death benefit, my insurance. Let's say it's $100,000, and it's been paying for my cash value. Let's say I have $50,000. Now, wouldn't you agree, Sandra, if my money has been paying for both things, for the insurance and the savings, and God forbid I passed away, shouldn't my family get both the $100,000 and the $50,000?
They should.
They should. But now, in most cases, in most cash value cases, what's going to happen is the company is going to keep everything inside of the savings side. You're only going to get one or the other. So even though my money's been paying for both, they're going to keep what's in the saving side. So can you
For
imagine?
what? For what?
You said
Are
for
they going
what?
to get to the family later?
Well, no. In this particular, the type of policy I'm talking about right now is typically like a traditional whole life. All the money inside of the cash value goes back to the company. The company keeps that.
Wow.
So if I got 100,000 of the life insurance, they'll pay that to my family. But then if I had 50,000 in the cash value, they keep that, which means this whole time I've been paying extra, Sandra, to have a savings that I either have to borrow and pay back, or if I die, they keep it. Right. And I don't know about you, that wasn't really advantageous to my family. Right.
Yeah.
So that's one type. Right. Now there's another type out there, and it's a very popular one right now, Sandra. It's also a type of whole life policy, or it's a type of permanent or cash value policy. They're called universal policies. All right. It's a very powerful or very popular policy going out there right now. And it works very similar to a whole life policy. The difference is the money inside of the savings or the cash value can be linked to an index, right? So it's not in an index, but it's linked to an index, right? It acts like the index. So it's not really being invested. The company's really holding the cash and paying off of how the index performs, right? So now they let me know is I could put part of my money in here. Well, it'll get higher rate of returns than a regular whole life policy. But if the market goes down, there's a floor. I won't lose my money. So it sounds amazing, right? It does everything that whole life is supposed to do. But now I have money that I can put inside of my cash value that will get a high, it'll get interest rate up to a certain cap. It will cap off at a certain point, and then I have a floor. But now with those type of policies, Sandra, you know how I was telling you with a whole life policy, you pay for two things. You pay for insurance and you pay for savings.
Yeah.
Well, in universal policies, you're paying for at least three things. The first thing that you're paying for is insurance. All right. I want y'all to remember that. That's the first thing you're paying for is insurance. The second thing that you pay for is fees. And when I say fees, it's a lot of fees, right? It can, and some of the fees go away. You got policy fees, you got surrender charges, right? You got the monthly cost of the insurance fees, right? And then whatever is left over from what you're paying, then that will eventually go inside of the investment. All right. So Sandra, let's say I'm paying that same $500 a month and I'm putting it in my universal policy. Well, let's say the first 5 years, I keep this policy, and let's say I've accumulated, just for example, $10,000 inside of it. Well, that's how much I have in my accumulated value. But now there's something called a surrender charge. What is a surrender charge? Well, that's the money if I would either withdraw money or if I terminate my policy that I really have access to. So for example, if I have 10,000 accumulated and my surrender charge is 8,000, if I want to use any of my money, I only have access to 2,000. Right? And that's a charge that typically lasts all the way to 15, sometimes 15 years. Right? The surrender charge goes down every year, but it takes a while for that to disappear, depending on how much money you're putting in it. Right? But then one of the biggest fees inside of it, Sandra, that we don't talk about and I didn't know about is something called the monthly cost of insurance. All right. And what does that mean? So a universal policy, we said, is a cash value. It's a permanent policy, right? But it has annual renewable term inside of it. So Sandra, think about it. It's a permanent policy, but the insurance is term. But what kind of term is it? It's the type of term that is called annual renewable term, or ART. And all that means is the cost for your insurance goes up every year you get older. All right. So for example, how much does it cost for a 20-year-old to have $1 million, $1 million policy? It's going to be very low. Why? Because that 20-year-old is expected to live until at least 80 years old. So he has time. But now what happens when that person gets older? How much does it cost for a 40-year-old to have that same $1 million of coverage? It's going to be more.
Yeah, it's going to be more expensive.
More expensive because they have less time. Right? So now, what's happening inside of this policy? So imagine, Sandra, I'm paying $500 a month. I'm paying my premium. But what I don't see happening inside of this policy is my cost of insurance is rising every year. So, for example, let's say I'm paying $500 a month. And let's say I'm 20 years old. The insurance only costs $50 a month. All right. Which means the other $450 is supposed to go into my cash value. But what's going to happen first is going to go into the fees first. Right.
Yeah.
But now I say I get 10 years older. I'm paying $500 a month. But now let's say at that 20 years later, the insurance now costs $350. What does that mean? That means only $150 is going into my savings.
So I want to find out if it costs 500 and you getting it at 350, what's the difference?
So that's a good question. So the 500 is what I'm paying out of my pocket. That's called the premium.
Yeah.
The cost of insurance is actually how much does the insurance cost for me that year based on my age. So remember, what's the first thing that your money is paying for out of the three? The first thing that it has to pay is the insurance.
Yeah.
So
the second is fees.
The second is fees, and then the rest goes into the savings account. So eventually, some of those fees will go away. Most of those fees will go away. The one that will remain is the cost of insurance. I got to pay for the insurance first. So yeah, so I'm paying $500 a month, but if it costs $350 for my insurance, less money goes inside of my cash value, which means all that interest is not going to mean very much because I'm only putting a little bit of money in there now.
True.
You get what I'm saying? But now, what if I get a little older? What's going to eventually happen, Sandra, is the cost for my insurance, the older I get, is going to eventually exceed and be more than what I'm paying. Right? So, for example, what happens if the cost of insurance is $700 a month and I'm only paying $500? What happens then? Do you know, Sandra, the company is allowed to go get the $200 that you need for insurance? They're allowed to grab that from your cash value.
What about if there's no cash value?
That's a great question. If it gets to the point where there's no cash value at all inside of it, the policy lapses. They're going to send you a letter. The company will send you a letter, say, hey, you got to pay the new cost of insurance. You got to pay a lump sum or you lose the policy. So not only do you lose the life insurance, but you lost everything inside of the savings too, because they've been using it to pay the insurance now. But what's the biggest detriment is it's happening when we need it the most. It typically happens when we're in our 60s, 70s, when we need the coverage the most.
True.
Right? So it happens to be one of the more predatory type of policies out there if we don't understand how it works. So for the majority of families, right, Sandra, that's not the way to use that money. And I'll give you an example. Because you ever heard a lot of families, they tell us, or a lot of advisors out there, they tell us, don't lose your money.
Yeah, don't lose your money.
Don't lose your money. But guess what happens? The first thing you do when you put money inside of the universal policy, what's the first thing that happens?
You're losing it.
From the door, from fees, from everything. And you're losing it for the first 2 to 3 years. So isn't it kind of strange that they say don't lose money, but the first product that I put it in there, I lose money immediately.
Sure.
Right? So that's why one of the things that I'm showing families is, hey, what's the best thing? Insurance was made just for a specific amount of time to protect your income. That was the purpose it was created. Right? So meaning right now, if I pass away, what do I need to happen? I need to make sure that if my house is not paid off, my wife has enough money to pay off my house. Yeah. Right? She has enough money to take care of the debt. She has enough money to take care of the kids. Right? Yeah. And the only reason I need the insurance is if I don't have enough money invested and saved that I can leave my family to do the exact same thing. So what I do is I get the most amount of life insurance that I can. And the best way to get the most amount of life insurance that you can for the lowest cost is called term insurance. But not just any term, you want level insurance that lasts you at least 20 to 35 years. Level. Why do I say 20 to 35 years? It's because I'll give you an example. It's going to cost less than what it does to get a cash value policy. So you can take the difference from what you were spending and put it in an investment, right? Now, what's going to happen over time? That investment is going to grow. So while you have your insurance for 30 years, 35 years, guess what's happening to your investment? It's growing.
True.
right? And let me give you an example, right? Sandra, do you know the S&P 500 has averaged over 10% since the 1930s?
Oh,
That's including the market going up and down. It's still averaged over 10%, right? Since the 1930s. So now, can you imagine? I only need life insurance for a specific amount of time. Once the house is paid off, I don't need the same amount of insurance to pay off a house if it's already paid off.
true.
If my kids are grown, I don't need the same amount of coverage that I needed in the beginning to take care, right? So what happens to my need for my life insurance? It goes down.
Yes, it becomes less expensive.
So do I need life insurance for the rest of my life?
No, because the major things you needed insurance for are being taken care of. Children in high school or college, and your mortgage, just what your upkeeps is what you need.
Not exactly. You just need the upkeep. Now, what happens if I already have the money for the upkeep? That means I no longer need to pay any company for life insurance because I have the money to take care of the upkeep now. I can use my assets from my investments. I can use the dividends that it's paying, right, to pay for all the upkeep and things like that. So I'm going to show families how not to eventually need life insurance, right? But we've been taught for years that you need life insurance for the rest of your life. And what I've learned is that's typically what life insurance companies teach us to keep us paying premiums for a very long time.
True.
So my thing is make sure when you're looking and you're protecting your income, the best way to do it is to protect it right now when you're younger and you use term insurance, but level term, not ART, right? Level term.
What do you mean by level term?
Good question. Level term is a term where you pay a premium and it does not change for a specific amount of time. So for example, if I have a level term for 30 years, that means I'm going to pay the same thing for 30 years, right? It doesn't go up.
But there are also some insurance that you get to do that you pay more.
Absolutely.
Oh,
Absolutely. Like for example, like when I was showing you about the universal or variable universal, all those type of policies, they have annual renewable term inside of it, which means the cost of an insurance goes up every year.
yeah.
And that's the most pure type of insurance anyway, but that's why it becomes very, very expensive in the end.
So with that, that means before you go into just get into, a lot of marketers, a lot of people out there trying to sell one thing or the other to you. You have to do your due diligence, do your homework, read yourself, and do not allow anyone to push you to doing what you regret. So you have to do your homework before you sign on.
And here's the thing about that, Sandra. When you look at these policies, typically if you're not in the industry and you don't understand the vernacular, it's very hard to understand, right? If we haven't been taught the language that's being used, it's very hard to understand. And I will say this: the more complicated the product, the better you can tell it's trying to take advantage.
True.
Right? If it has a very long name or it's a whole bunch of things inside of it, right, and it becomes complicated, there's a reason why it's complicated.
Yeah, so that there's some things you're not able to find out and you get into it before you get to know.
Absolutely. And as adults, what's going to happen is we have pride and we don't want to let people know that we don't know, right? So when it's very complicated, sometimes as adults we'll be like, okay, yeah, I know.
Yeah,
We
I
don't.
understand.
Yeah. And it happened to me, right? It happened to me, and that's the only reason I even got in this industry. Other than that, I'm a minister of music. I'm an ordained minister. That's my life. The only reason I got into it is because it happened to me. It happened to my family, and we didn't have the understanding, and we needed somebody to get in there, learn how it really works from the inside out, so that way my family, at minimum, would not be taken advantage of.
True.
So yeah. So Sandra, that's one of the things. I know there's so many different things I can go in and talk about, but I know mainly today we wanted to talk about what's the
How to
best way
protect your
to
money.
protect your money.
Thank you so much. I want to thank you for that time. Thank you for that breakdown that you gave. It was quite explicit. And I know that it's simple for anyone who gets on this video to just understand. at a face value. So, and this is just to inform us that in order for you to protect your money, because we're not meant to lose money. Money is meant to, we're meant to make money, multiply, and manage money to ensure that the money keeps multiplying even when we cannot work. And this is what Bobby Jackson is just taking us through. How do you protect the money you have? How do you protect it in such a way that the money keeps increasing and not decreasing? So, what and where do you put your money? So you have to understand it before you just embark on, oh, my friend told me it's a good one, it's juicy. We are all adults and we take responsibility for every decision that we make. We are all sum total of the decisions we made several years ago. So whatever happens to you in the next few years, it's about the decisions you're taking right now. And then the decisions are not taking you to where you want to be, then you have to go back to your drawing board. Find out what decisions you're making and see how you can correct them in order to have a better tomorrow. So, like Jackson just rightly told us, we need to do our homework. I think a lot of times why people fall into such is because they are lazy. They are not able to search this information themselves. What would you say about that?
Definitely, that's definitely one of the reasons that I find it like three reasons they never get around to it. They didn't understand it, and they didn't have anybody to teach them. One of the biggest things, is, Sandra, is nobody taught us this, right? And then those around us, if they don't know it, then it's easy for us to be taken advantage of as well, right? So, and that even to your point, there is an adage that if you want to hide something from somebody, put it in a book.
Yeah, true.
Right. And there's a book. Matter of fact, there's a book out there. I think I was sharing with you this the other day. There's a book called "What's Wrong with Your Life Insurance?" Right. If you really want to learn how it works, it's by a guy that's not in the financial services industry. He really did how it worked, right? But he goes over every type of policies, the pros and the cons, right? It's by Norman Dacey, right? Norman Dacey, What's Wrong with Your Life Insurance? And if you really
Can
want to
you
learn,
send me the title? Let me search it out.
yes, I would definitely send you the title.
But in this book, was there any breakdown? Is there any breakdown about the type of insurance that's available?
It's a breakdown of every type of life insurance. He breaks down term insurance. He breaks down whole life insurance, universal insurance, how it's marked. He breaks it down in a way that you can understand it as well.
Oh, I need to get the book as soon as possible.
Absolutely.
So I want to thank our viewers. I want to thank everyone that's been on the show. Thank you for making the time to join us on Money Matters on Friday. Thank you for joining us. And if you do have any question, you want to reach out to Bobby, you can shoot me a mail or you find our number in the description below. So I want to thank Bobby Jackson for his time. Thank you so much for making the time. Thank you. I think I have a better understanding on how one can protect one's money. Finding out that there are different insurance out there, but you have to do your homework to know which way to go. Thank you so much. Do have a blessed evening until we meet in our next episode. Stay blessed. Bye.
Yes.
If you've made it this far into this video, thank you for watching. And don't forget to subscribe so you can support your girl. Thank you.